The best way to think about a bank is in terms of its balance sheet. A standard company's balance sheet shows assets on one side and liabilities and equity on the other side. In a simple version of a bank, the assets are loans and the debt is deposits. In practice, it can be more complicated. There are a variety of different kinds of deposits and types of debt that are not deposits, and there are a variety of different kinds of loans, and also assets that aren't loans. One of the tasks in bank management is determining the kinds of assets and liabilities that a bank should have. This can vary significantly from bank to bank, depending on what kind of market it serves. Items on the right-hand side of the balance sheet are called sources of funds. Items on the left-hand side of the balance sheet are called uses of funds. First, we'll go through the various kinds of items that make up the sources of funds, and then we'll go through the uses of funds. Again, sources of funds are items on the right-hand side of the balance sheet, money that can be used to make loans or to make other investments. We can divide the sources of funds into three categories: debt, which consists of deposits and borrowed funds, and equity. There are various kinds of bank deposits. Transactions accounts are deposits used for making payments. These are commonly called checking accounts. Another name for checking accounts is demand deposits, because the money is available on demand. Some demand deposits do not pay interest, which was the law until 1980. Demand deposits that pay interest are called now accounts. Savings deposits are the traditional way people save their money at the bank. Historically, there were restrictions on what interest rates could be offered and how the funds could be used, but these regulations have been relaxed over time. Money market deposit accounts are savings deposits that offer limited checking. The depositor is limited to 6 transfers per month, excluding in-person transfers, but this limit may be suspended. While money market deposit accounts is the formal name for this type of deposit, banks may call them by something else for marketing purposes. Time deposits are accounts with a fixed maturity date. If the funds are withdrawn from the account before the maturity date, there is a substantial penalty. This reduces the liquidity of these assets, which is bad for the consumer but good for the bank. Typically, they offer higher interest rates as a way of compensating for the lower liquidity. Time deposits are also called certificates of deposit, or CDs, and are a common way for individual investors without too much money to save. Negotiable certificates of deposit, sometimes called jumbo CDs, are very large CDs that can be traded in a secondary market. The secondary market provides liquidity to the holder without requiring the bank to pay out the funds before maturity. Borrowed funds are money that the bank borrows from other institutions or that it raises from issuing debt securities. Since it can be difficult to increase consumer deposits quickly, borrowed funds provide flexibility for the bank. Banks can borrow directly from the Federal Reserve. That part of the Federal Reserve is called the discount window, but that's not common in most circumstances. Or they can borrow funds from another bank that is holding an account at the Federal Reserve. These are called federal funds, or more commonly, Fed funds. Similar to this is a transaction called a repurchase agreement, sometimes called a repo. A bank sells a security, typically a government security, to another bank with the promise to buy it back the next day at a slightly higher price. This is effectively a collateralized loan. The bank that sells the security gets the money now and then returns it later. The difference between the price the security was sold for and the purchase price is the interest on the loan. The security held by the lending bank serves as the collateral for the loan. The name for the other side of a repo transaction is a reverse repo. While overnight lending is common in the U.S. repo market, which means that the loans need to be renewed every day if needed, there are loans with longer maturities. These are called term repos. Dollar-denominated deposits at foreign banks or at foreign branches of U.S. banks are called eurodollars. Banks can borrow and lend in the eurodollar market, and so they are another source of borrowed funds. A banker's acceptance is an instrument issued by a bank that promises to pay a certain amount to the holder on a future date. These are often used by merchants in international trade to make payments, since the payment is guaranteed by the bank. There is also a secondary market for these instruments. When a bank issues the banker's acceptance, it receives the money up front and so is a source of funds. And since it must make good on the payment in the future, it is a liability for the bank. Another source of funding is bonds and notes. Traditionally, corporations issue bonds when they want to raise funds using debt. Banks can do the same, either by issuing bonds or short-term notes. However, these securities do not make up a large share of the sources of funds. Raising money through deposits is typically cheaper for a bank. Banks can also raise funds by reinvesting profit or issuing new equity. In the context of banks, we often refer to equity as bank capital or the capital account. Equity can be a more expensive way to raise funds than deposits, so banks will sometimes try to limit the amount of capital they use. Because of this, banks are required to have at least a minimum amount of capital. These capital requirements will be discussed in detail in another video. It's important not to confuse bank capital with bank reserves. When banks raise funds through issuing capital, they use those funds to make loans, so the money isn't sitting around in reserve. Rather, capital represents the bank's ability to take losses without becoming unable to return what they owe to their depositors. For example, imagine a bank that has only loans and deposits. Here is the balance sheet of a bank with $100 of each. If the economy goes into a recession and $10 of the loans default, the bank now only has $90 of assets, but $100 of liabilities, which is a problem. We would say that the bank is insolvent. Now, imagine a bank that raised the money by having $80 of deposits and $20 of equity. When the value of the assets falls to $90, it can still cover all of the depositors, so the bank is still solvent. The equity holders lose half of their investment, but that's part of the risk of being an owner of a company. In this way, capital represents an ability to sustain losses and protect the depositors. One of the basic questions in corporate finance is determining the best way to raise funding. This is true for banks as well, although the problem is a little different, since deposits are a source of funding available only to banks, and banks face various regulations about how they raise money. On the debt side, deposits are often a low-cost way to raise money, particularly consumer deposits. However, this is not always true, since transactions deposits can impose significant processing costs on a bank. Often, companies see equity as an expensive way to raise money, and this can also be true for banks. However, as we'll see in a later video, banks have regulations which limit the amount of leverage they can use, and so forces them to raise more money through equity than they would if they were unregulated. Banks will differ in how they raise money depending on characteristics such as their size and the markets they serve. For example, consumer-focused banks with many branches may have more access to deposits than purely business-focused banks. The other side of the balance sheet, the asset side, is where we find the uses of funds. Cash assets are highly liquid assets that are held for their usefulness in transactions rather than for the interest they generate. Investments provide both a return and liquidity. It is easier to increase or decrease the amount of investments than the amount of loans, so investments provide some flexibility for a bank, although they earn a lower return since the market for investments is more competitive. Loans represent the primary business for commercial banks and for most banks, and generate the bulk of their earnings. The other category can include trading accounts, intangible assets, or tangible assets such as real estate. Again, banks will hold different mixes of assets depending on the size of the markets they serve. There are a variety of different kinds of cash assets and investments that a bank can hold. Vault cash is currency held by the bank. This includes both cash held in vaults or at ATMs owned by the bank. Banks hold vault cash to serve their customers who may wish to withdraw coins or currency to use in spending, or for businesses who want to have cash on hand for their own customers. The reverse is true too. Businesses may deposit currency at the bank when their holdings of cash become too large. Reserves held at an account at the Federal Reserve serve two purposes. First, they are used when making transactions from one bank to another. For example, if a check written on Bank A is deposited in Bank B, instead of literally sending funds from one bank to the other, the Federal Reserve can debit Bank A's account at the Federal Reserve and credit Bank B's account. Also, banks may need to hold a minimum level of reserves at the Federal Reserve to meet reserve requirements. Investments are longer-term securities that offer both income and liquidity. Commercial banks are limited to holding debt securities. Typically, these are low-risk securities such as Treasury or municipal bonds or agency securities. However, there can still be substantial risk, as we saw with mortgage-backed securities in the 2007-2008 financial crisis. Before discussing loans, I want to introduce some terms. A promissory note is a promise made in writing to pay the lender a particular amount of money at a specific date. A secured loan is one that is backed by collateral. Collateral is something that can be taken by the bank if the borrower does not repay the loan. Collateral can include such things as real estate, a car, or a business's inventory. The existence of collateral makes the loan less risky for the bank. An unsecured loan is a loan that is not backed by collateral and, everything else being equal, offers more risk for the lender. The interest rate on a loan can be either a fixed rate or a floating rate. With a fixed rate loan, the interest rate stays constant for the life of the loan. With a floating rate loan, the interest rate will go up or down depending on what happens with market interest rates. Typically, the interest rate on a floating rate loan will be expressed as some base rate plus a premium. For example, the rate on a loan might be the Treasury bill rate plus 4%. If the Treasury bill rate increases, the rate on the loan would also increase. There are a variety of different types of loans, categorized by how they are constructed, who the borrower is, and what the money is used for. Under business loans, or commercial and industrial loans, we have bridge loans, seasonal loans, and long-term asset loans. A bridge loan is used to temporarily fund an activity until the revenue from the activity comes in. A seasonal loan is also a temporary loan that covers a mismatch in costs and revenue because of seasonal fluctuations in either. For example, a retail store may need to purchase inventory in October to fund Christmas sales in December. A long-term asset loan finances the purchase of assets such as equipment that must be paid for now but will generate revenue for some time into the future. Real estate loans are for the purchase of properties or to pay for construction and development and are a very common type of loan for banks. Agricultural loans are loans to farmers to finance purchase of farming supplies. These kinds of loans are more common for banks serving rural areas. Consumer loans are loans to individuals, sometimes to finance the purchase of a specific item, such as an automobile. Credit cards are a common type of consumer loan, which can be offered by a bank or sometimes by a non-bank financial institution. Lease financing is where a bank purchases an asset and then lends the asset to a company, in contrast to the bank lending money to the company directly and then the company purchasing the asset. If the bank is in a higher tax bracket than the company, which is likely for small companies, the bank would get a larger tax deduction for purchasing the asset. If they pass along some of the tax savings, it may be cheaper for a company to lease the asset than to borrow the money and buy the asset themselves.